This is a book bull summary of the book Venture Deals by Brad Feld. Enhance your company's growth with effective negotiation skills. Every year, numerous startups emerge worldwide, especially in the tech sector driven by innovation and the internet. While the potential for success and profits in this realm is vast, so are the risks. Most startups fail, wasting valuable time and resources. A major reason for these failures is the struggle to secure adequate funding. Traditional funding avenues like bank loans often remain inaccessible to most startups. However, these insights will guide you on how to overcome this obstacle by raising venture capital. Through these insights, you'll discover essential strategies for identifying the right investors, persuading them to invest in your venture, and securing the best possible deal for your company's growth. Why venture deals are ideal for startups. Picture yourself finally putting your brilliant business idea into action. You've launched your company and assembled a motivated team. But what's the missing piece? Yes, money. However, funds don't just appear out of thin air. So, where do you find it? Many startups turn to venture capital to fuel their growth. Venture capital involves receiving a cash infusion from investors, known as venture capitalists, VCs, in exchange for ownership stakes in your company. While not the most common funding route, it can be incredibly effective for innovative startups with bold ideas. Unlike traditional bank loans, venture capital doesn't require a lengthy operational history, making it ideal for startups. Even some of today's tech giants like Google started small and relied on venture capital to kickstart their journey. Google received its first venture capital boost of $100,000 just 2 years after its inception. This injection was pivotal, enabling rapid expansion and leading to the establishment of Google's own venture capital arm. However, navigating venture capital can be tricky, especially when dealing with diverse stakeholders and their varying objectives. As companies secure multiple rounds of financing, they often acquire multiple investors, each with their own agenda and level of influence. For instance, while one investor may prioritize quick profits and advocate for risky strategies, others may favor a more conservative approach focused on long-term success. In essence, venture capital can provide crucial funding for startups, but it comes with the challenge of managing the interests of different stakeholders with differing goals. Navigating venture deals, prioritize investors. When pursuing a venture deal, it's not just the entrepreneur and VC involved. With lawyers, mentors, and others in the mix, negotiations can easily include 6 or more individuals. Despite the number of parties, entrepreneurs should prioritize understanding and engaging with the investors, typically the VCs. Investors, while representing their firm's interests, vary in hierarchy, from managing directors to analysts. The higher the position, the more decision-making power and genuine interest they likely hold. While an associate or analyst interest may seem promising, it's often routine. Aiming to engage with general partners yields greater impact. Focusing on the investor streamlines communication, vital for long-term efficiency and minimizing misunderstandings. However, it's essential not to overlook other involved parties. Regular check-ins ensure alignment and representation of all stakeholders' interests. While managing multiple parties can be challenging, preparation for the deal itself remains paramount. Understanding the dynamics of venture capital. Venture capital can seem like a complex web of investors, firms, and companies, making it challenging to navigate. However, there are 2 key insights into how venture capital operates that all entrepreneurs should grasp. Firstly, venture capitalists, VCs, acquire their funds from various investors known as limited partners, such as banks or government funds. VCs earn a percentage for managing these investments but earn more when they deliver profits. It's crucial to recognize that VCs must consider the interests of their limited partners when making decisions. This understanding is vital when seeking investment. While VCs often spread their investments across numerous startups to maximize profit potential, this may not align with an entrepreneur's goals. In such cases, entrepreneurs may find better fits with other investors who offer more focused support. Secondly, VCs operate within strict time frames. They typically receive new funds from limited partners every 3 to 5 years but can continue investing in their portfolio companies for longer. However, toward the end of the funding cycle, VCs may face limitations on further investments due to fund depletion. As a result, the later a VC is in their financing cycle, the riskier it becomes for entrepreneurs to rely on them for additional funding. To mitigate this risk, entrepreneurs should inquire about the timing of the VC's last investment and when they anticipate receiving new funding. If a VC struggles to provide clear answers, it may indicate unreliability as an investor. The key to successful venture deals: understanding the term sheet. In today's investment landscape, a simple handshake no longer suffices to ensure mutual understanding and compliance with agreements. Nowadays, transactions are documented in term sheets, which outline the financial terms between venture capitalists, VCs, and entrepreneurs. Key elements of term sheets revolve around financial matters, demanding entrepreneurs' vigilance to avoid relinquishing significant future returns due to oversight or investor tactics. Misunderstandings often arise, particularly regarding financing terms. For example, VCs and entrepreneurs may interpret valuation differently, potentially leading to discrepancies in ownership percentages. Moreover, during challenging times, some investors may attempt to back out of commitments. Entrepreneurs can safeguard against this by implementing a pay-to-play strategy, which links investors' ownership to their financial contributions. Another critical aspect of term sheets involves control, specifically the influence investors wield over company decisions. Despite typically holding less than 50% ownership, investors exert substantial influence through board membership, especially when equipped with veto rights. A balanced board typically comprises 2 founders, CEOs, 2 VCs without veto power, and an independent expert. Understanding these dynamics lays a foundation for navigating venture deals effectively and sets the stage for exploring successful venture capital fundraising strategies in subsequent discussions. Essential preparation for meeting with venture capitalists. Before seeking funding from venture capitalists, VCs, for your business, it's crucial to take several preparatory steps to mitigate potential pitfalls. First and foremost, ensure all your materials and presentations are clear and compelling. Most investors will request a concise company description, an executive summary, typically 1 to 3 pages outlining your company and strategy, and a comprehensive presentation providing deeper insights into your business. These materials shape the investor's initial impression, highlighting the importance of their quality and professionalism. Although VCs may not always demand detailed business plans and financial models up front, it's wise to have them prepared along with other pertinent information like employment agreements. This proactive approach saves time and alleviates stress for both you and potential investors if such documents are requested. Additionally, identifying the right VCs for your venture is essential. Fortunately, many investors maintain websites, blogs, and social media presence, facilitating entrepreneurs' research into their investment focus and personal interests. Utilize this information to tailor your approach to specific investors, enhancing both professional and personal engagement. Furthermore, seek recommendations from fellow entrepreneurs to identify suitable investors. Their first-hand experiences offer valuable insights that may not be readily available through public channels, aiding in the selection of compatible investors for your business venture. The importance of a skilled lawyer in securing successful deals. Imagine you're at the negotiating table with your investor, on the brink of a breakthrough in the business world. Everything seems promising until your lawyer gets hung up on a minor detail and begins acting rudely. Panic sets in as your aspirations start to crumble before your eyes. Clearly, you're not working with the right lawyer. A proficient lawyer should adeptly structure and finalize investment deals while keeping focus on critical matters like finance and control. In negotiations, venture capitalists often hold the upper hand due to their experience, leaving entrepreneurs at a disadvantage. Hiring a competent lawyer is crucial to bridge this gap. Alignment between you and your lawyer is paramount for success. Your lawyer must grasp your concerns and collaborate effectively. It's detrimental to have a lawyer who disregards your input. Ensure you set the agenda, and your lawyer supports rather than hinders your efforts. For instance, an inexperienced lawyer may fixate on minor issues like patent rights instead of prioritizing ownership. Such distractions prolong negotiations, leading to wasted time, money, and energy. To find a suitable lawyer, seek recommendations from fellow entrepreneurs who can offer insights into their negotiating style. A good lawyer needn't have exorbitant fees or prestige. Prioritizing a lawyer from a specialized firm can better serve your startup's needs. Despite stereotypes about lawyers and the challenges of finding the right one, investing effort into securing competent legal representation pays off in the long run, ensuring your interests are well protected. Mastering negotiation. Half the battle is preparation. Imagine you, a budding startup, stepping into the office of an experienced investor. The nerves kick in as you worry about making mistakes and losing her interest. But fear not. By following these steps, you can ensure she listens and you get what you want. Firstly, clarify your desires. Articulate what truly matters, including questions about investment amount and business control. Avoid getting lost in details. Compromises are normal, but stay firm on your key points regarding money and influence. Set your boundaries and be ready to walk away if needed. Stick to your limits, like not giving away more than 50% of your company's shares, regardless of investor pressure. Secondly, understand the investor's goals and constraints to shape your strategy. While entrepreneurs focus on building their companies, investors juggle various personal and professional factors. This can benefit startups negotiating with seasoned investors. For instance, a startup negotiating with an investor about to begin vacation may have leverage as the investor rushes to make a decision. However, integrity matters. Early negotiations set the tone for long-term relationships, so both parties should aim for mutual benefit. Balancing sharpness with integrity. Negotiating happens daily with friends, family, and coworkers. But in business, it's serious business. Here are some tips for negotiating with potential investors. 1. Be transparent. It builds trust and sets the stage for a lasting relationship. 2. Trying to outsmart investors by hiding information backfires. Eventually, they'll uncover it, damaging your reputation and chances for funding. 3. Understand your negotiating partner's styles. If they focus on details, prepare your key points and stick to them. 4. Consider multiple investors. Competition can lead to better terms, but keep other investors' details confidential to avoid collusion. Negotiating is about creating value and building trust, not trickery or secrecy. Watch out for common negotiation pitfalls. Negotiating with potential investors holds immense importance for entrepreneurs. Here are some key tips to steer clear of common pitfalls. 1. Wait for their move. In negotiations, it's often wiser to react rather than initiate. Allow the other party to reveal their intentions first. For instance, when presenting terms to an investor, let them take the lead. They might offer more favorable terms than you anticipated. 2. Patience and listening. If you're unsure what to say, listen attentively. Opportunities arise when you stay attentive during negotiations. 3. Respect rejections. If a venture capitalist declines your proposal, accept their decision gracefully. It's not personal. They simply may not be the right fit for your venture. Avoid unnecessary follow-up emails or requests for referrals. 4. Customize communication. Tailor your communication to individual investors and respect their time. For example, if an investor stipulates a minimum 30% control in companies they invest in, don't waste their time if you can't meet this requirement. 5. Leverage your team. Surround yourself with a strong team. Investors are often drawn to ventures with robust teams due to their potential for higher profits and motivation. By implementing these strategies, entrepreneurs can navigate negotiations more effectively and increase their chances of success. We hope this video provided valuable insights and information for you. What is your biggest key takeaway? Let us know in the comments below. And if you learned something new, make sure to hit the subscribe button for more videos like this. Thank you, and until next time.